Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors. Welcome to today's Groundhog Day edition of Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. Got a jam-packed show for you this morning. 3 guests. First at 8:15, we're going to be joined by Evan Schnidman. He's the founder and CEO of Prado Analytics. He's going to be able to tell us, based on what the Fed did yesterday, what they'll be doing going forward. And then at 8:35, we're going to be joined by Craig Johnson. He is the managing director and technical market strategist at Piper Jaffray. And then at 9 a.m., we're going to have another good guest for you. That's Sandy Chaikin. She is the wife of Mark Chaikin, and she has a very interesting story about how she went from not managing any of her own money to successfully becoming a trader. And so she's going to tell us how she made that journey in a relatively short amount of time. Want to remind you folks that today's show is brought to you by Chaikin Analytics with their groundbreaking stock research tools, including the Chaikin Power Gauge. Chaikin Analytics simplifies complex investment decisions. You can register for Sandy Chaikin's free webinar. It's actually today at 4:15 Eastern. It's called Investing 101, a 5-step guide to finding winning stocks in 15 minutes a day. Sandy's presentation is appropriate for all investors, from novice to knowledgeable. To register, you can go to chaikinanalytics.com/premarket. That's chaikinanalytics.com, CHAIKIN/premarket. On today's show, we got to talk about Facebook. We got to talk about international paper. We got to talk about Shutterfly. So let's get right to it, Joel. How are we doing on the S&Ps?
We're not having Bill Murray on?
We should. I messed up.
Do you know that I've never seen that movie all the way through? Caddyshack. People say it's one of the greatest movies ever. I've only seen
Groundhog Day you want to talk about, though. Not Caddyshack. Come on,
Caddyshack,
Joel.
Groundhog Day. You know, what's the difference?
You've never seen Groundhog Day all the way through?
This conversation is Groundhog Day.
Groundhog Day is one of the best movies ever made.
All right, I will have to go home and.
You got to put that on the bucket list. Groundhog Day is awesome.
All right, S&Ps are weak this morning, down 4.5 points. Double close is 74.50. That's our bogey on the upside. On the downside, we took out yesterday's low, but we haven't taken out the double bottom from Monday and Tuesday, down at the 22.63 area. Gold showing some life here, up 14.40. The gold trade is on here, breaking above that resistance while we're right at 220. And crude, that moving up nicely as well. So let's move on to the S&Ps. We got a rundown on them. Dennis, how you doing this morning?
Well, looking here, mixed market, I'll tell you. You know, S&Ps are trading down here, but there is a lot, and I mean a lot of stocks trading higher here this morning. So just because we're down doesn't mean everything's going down. A lot of individual stock news, obviously, driving up a lot of the stocks that are trading higher here. But looking at that mixed market overall, so financials a little bit weak here. They're trading down here. European financials down significantly overnight. Deutsche Bank down 4% here overnight. That's a big fall, so I wouldn't be surprised to see a little bit of pressure there. But lots of individual earnings reports to talk about here, Joel. And should we start with the biggest of them all?
Yeah, the granddaddy of them all, Facebook.
Spencer, what did Facebook have to say?
I guess that's my cue. Q4 EPS of $1.41 versus $1.31, so strong on that. Sales $8.629 billion versus $8.51, so strong there. Let's look at some active users now. December daily active users, 1.23 billion. That's up 18% year over year.
Wow.
Mobile DAUs for December, 1.15 billion. That's up 23% year over year.
Wow.
December MAUs, 1.86. That's up 17%. And mobile MAUs up 1.74, up 21%. On the call, they did issue some guidance as well. They said they see fiscal year adjusted total expenses up 47 to 50% year over year. This year will be, quote, an aggressive investment year, is what they also said, and total GAAP expenses up 40 to 50% year over year.
That was an awesome report, I'll tell you that. You can look at the stock and say, it wasn't that great. Well, stock price, regardless, they did a lot of things right in that report. And we were saying coming into it, it's going to have to be really awesome for the stock to go higher. It is really awesome. The stock is higher, just not significantly higher. But on the initial numbers, we did get a pretty good spike, Joel. How high did we get?
137.99. If that 138 was the whole number that you were picking, you just missed it. Now developing some support or resistance just above 135 here. Someone's definitely picking on this area. You can see this is over the last couple hours, so I'll call that minor resistance. Coming back on the downside, you do have a glimpse of getting into yesterday's range, which I think is pretty important. Yesterday's range on the daily charts, 33.23 was the close. You missed the all-time high by a penny, which was 33.49. So, I don't know, good levels, 33.50 to 35. I think those are your early parameters.
Hard to bet long term against this company when they produce quarters like that, but it is all about expectations, and I'll continue to reiterate that point, on the show, is that when a stock runs up like it has in 2017 from 115 to 133, when it runs up 15 points ahead of the report, 20 points almost ahead of the report, talking to the tune of 17, 18% in a month, it's a lot of times very difficult for the stock to go higher, even when they do blow it away. And, we are trading up here, but if you were betting on Facebook going up another 10 points on this earnings report, it was going to be difficult running after that big move that it's already had. So that being said, though, I'm not coming out here short in the stock today saying, it's already had, because that quarter is just a really good quarter. From a fundamental perspective, this company just blows it away every time.
And I was looking at a pattern after the last earnings report, or when it made its all-time high. I'll pull up the statistics here on Facebook. What did they do last quarter? Last time they reported Q2 on November 2nd. So let me get.
They hit the stock.
They did. Did they hit it on that day?
They hit the stock. Yeah, you can see that day went from 130 down to 120. That's the big gap down day because they report at night, so you always got to look the next day for the move, and you can see the big down move is the next day on the 3rd.
But they did have
down to 119.50.
They did have a good report though. It was
and that's
report.
what we're saying again. It was the same story last quarter. So even you go back, it's all about sentiment going in. And if you see the same story, the stock could run up through the summer, run up, trading near the highs going into the report, and expectations simply too high.
Should we see how the option boys were doing on this one? See if there was anything.
Check it out. Yeah, go check it out. I didn't open my options platform yet. I often don't open it because they don't actually open till 9:30. So if you got yours open, check it out. Okay. Look at the 130 call and put, or whatever you want to pick your poison. You can look at the 135.
Let's look at the
add them up, see what they are.
Well, the 135. It closed at 133.5, but the 135 straddle was expensive. That was let's call it close to a little over $6, $6.50. So
a lot.
Yeah, you were talking
straddle
about
writers win again, Joel. Man, we just give up and just become straddle writers.
Yeah.
Just going to be full-time straddle writers. Forget about all my other strategy. I'm looking to write straddles for a living.
But we'll do.
They seem to work a lot.
Except
that one or two times they don't, you get blown away.
Let's see here. Just interesting. We're trading. Let's call it 135 here. If you would have bought in a 133 call, you're losing money here. It went off the board 350, 355. So if you paid, let's say you paid $350 for it, you need $136.50 to break even on that one. So the option guys are tough on this one. Looks like they've done a pretty good job.
They do their homework, those option people. They know how to price these things, Joel, so they make money. So anyways, Facebook obviously, got the big lift and, a pretty good lift, but it's giving it back here. So we've talked a lot of other earnings here, though. So let's jump in because we got a lot of guests here today. We have 6 minutes here. Can we pound through a few of these? Let's go over to Merck. Merck reported here this morning, and Merck is trading higher in the pre-market here. I'm looking at the $63 level. This is where it kept getting up to. Let's get the numbers, though, from Spencer before we do our fundamental and technical analysis.
Q4 adjusted EPS 89 cents as in line. Sales 10.1 billion versus 10.22, so a slight miss there as far as guidance goes. Fiscal year 17 adjusted EPS of $3.72 to $3.87. That's right in line with the estimate. And sales of 38.6 billion to 40.1. That's also in line with the estimate.
Looking at the book, 62.50, 30,000 to sell, 62.60, 14,000 to sell, 63, almost 100,000 to sell. That's my number. 63 is my bogey. I think it's going to have trouble opening over there, but it's traded 28,000 shares already. So, and it's very, very early. So it's probably going to trade like 100,000 shares before. So it's not saying it's impossible for it to open over 63, but that's where it struggled technically. I see a seller there in the book. In this quarter, it doesn't look like it's a blowaway quarter to me here. That's why I think it struggles at 63. That's my call.
And I'll just have to concur with you. Pre-market high 62.98. Hit there a couple times in the pre-market. You had a high at 63.16 back on January 11th. It's been a wide range, but this thing has been range bound. All the good news, which has been bad news for Bristol Myers, still 61 to 63. Had that brief dip to 60. So you got your level, you got your size. If it blows through it like it did AMD at 11, look out. But that's a good number to keep an eye on.
The weak get weaker. Ralph Lauren, this is one of those to say, well, if they do anything okay, the stock might rally. Well, Spencer, give us the numbers from Ralph Lauren.
I was on mute. Sorry about that. Q3 adjusted EPS $1.86 versus $1.64. Sales of 1.7 versus 1.71 billion. So a beat on the EPS and a miss slightly on the sales numbers. They did reaffirm their fiscal year 17 outlook though. So
doesn't sound that bad. But anyways, you're a retailer. We don't like retailers anymore. Down 10%. We saw what they did to Under Armour on a quarter. Well, you missed on sales. Now we punish you. Down 10% more, Ralph Lauren. Stock that was $110 back in December, closed at 87, is now $78. And these retailers are so out of favor. They are more out of favor than, besides Macy's, which we're going to get to here in a second. But the retailers are more out of favor than the drug stocks now.
And, big hit for Ralph Lauren here, trading at the lows of the pre-market session, 77.75. That's your pre-market low. Trading a buck above that right now.
Ugly.
Haven't been under $80 here since late 2010. You had a low at 76.88. So if the move continues, keep an eye on that. Also, half and whole numbers are good, but man, what a shellacking. Who knows if it goes into rally mode? If it does go into rally mode, maybe a psychological $80 could be a level, but just drifting lower. As I mentioned, you're low in September of 2010, 76.88.
If you want to look at pure sympathy plays, I always look at PVH. That usually has a sympathy move, and it is trading down $1.50. Also, I look at VF Corp. But VF Corp now is trading down $1, but it also caught a downgrade from Goldman Sachs as well. So a double whammy for VF Corp, getting downgraded here today by Goldman Sachs, plus the Ralph Lauren earnings is hitting VF Corp here this morning as well. So both these stocks, VFC, PVH, both trading near lows coming in. Look like they're going lower here this morning.
Spinner mentioning Mr. Market always hits an issue. The CFO departed there from Ralph Lauren. So double dose of bad news for Ralph Lauren.
Jumping over here just to a couple other stocks in the news. While we're in the retailers, we might as well talk about Macy's. The New York Post article out there, Spencer, this morning, it's giving Macy's a left. It's one of the only retailers trading higher here this morning. Are they potentially in play?
Well, Terry Lundgren is in his final weeks as the CEO of the company, and then he is apparently being approached or not opposed to being approached to a takeover.
So Macy's is saying basically, hey, if somebody wants to buy us, we'll listen to offers.
Who would buy them?
I don't know. That's what I don't know. Which retailer is in a strong enough position right now to come in and buy them?
Private equity?
Private equity would buy them.
Yeah,
maybe. Well, and there's 5% dividend. There is some value here if you think you can turn this company around. But like I said, and my concern here with Macy's, okay, let's say buyer doesn't materialize here. It's just this, big department store, upscale. It's just not, and you think the way the Sears went, JCPenney, theirs were lower, but those used to be cornerstones there. And I keep thinking, I can't get it out of my head that, Oakland Mall there, and you look at the big sign, Sears, JCPenney, and Macy's. And I'm like, well, Sears, they went to the, we know where they've went, and J.C. Penney, we know where they've went, and I mean, it's the third one, Macy's. Maybe Macy's is going the same direction here. So I'm not a fan of Macy's. I know it looks like it's good value here. I still think it's a value trap. It's been, I'm glad I haven't bought it. It looked like value at 40. It looked like value at 35. Looked like value at 30. Maybe it gets taken over. I don't know, but I'm not going to be participating with it. I'm out. I'm out on Macy's.
I mean, with these malls, and I can't remember which guest it mentioned, but are they just going to be like, landing pads for the Amazon drones to, deliver everything? Just gut everything? And who was it that mentioned that when I was talking negative about the REITs? Can you remember, Spencer? Nope. Okay.
No.
Boy, I still wish I had my 44 November weekly puts here in this, but got to go out a little bit longer. We'll see. Dennis, you've talked me out of buying this a couple times. It puts a couple lows in, and it looks like it's going to rally. But you got the news. Unless something materializes, this could easily give back all its gains. Pre-market high 30.85.
RCA saying is a real estate play. Is that where the value is? Maybe. There's an argument to be made there. But as a viable business here, maybe it's viable, but I just don't think it's going in the direction that I want to participate in. So, like I said, if you wanted to, talk to big department stores, I like Kohl's better than Macy's. Although I don't like any of them right now.
All right, it's
Jump
eight,
in. Oh.
it's 8:16.
Oh,
So
8:15.
yep, I know. Time flies when you're having fun. So we're gonna take a quick break and grab Evan Schnidman. He is the founder and CEO of Prattle Analytics. We'll be right back. Welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. We're now on the line with Evan Schnidman. He's the founder and CEO of Prattle Analytics. Evan, how is it going this morning on this Groundhog Day?
It's good. I actually haven't even looked what the Groundhog's doing.
He saw his shadow. So, more winter for you and me.
It's not surprising at all.
All right. Prattle Analytics, we've had you on the show before. Prattle looks at Fed, like what the Federal Reserve officers actually say, and it analyzes the text of their speeches. So based on yesterday's decision to keep rates stable, what did you interpret as to what that means going forward?
Yeah, so ahead of every FOMC meeting, we put out a projected score using a statistical projection of existing trend in Fed sentiment. Our trend projection expected a score of 0.46, so a little bit hawkish. And the actual projection came in a little bit below that at 0.21. So what that tells us is essentially it was a little bit less hawkish than what the market was anticipating. And I think this is pretty consistent with the subjective analysis that we've seen out there over the last 20 hours or so. But really, what that means for the long run is the Fed's still base case 3 hikes this year, but March is looking a lot less likely.
So a lot less likely in March. Is there a particular point that you can point us to that maybe a rate hike is more likely?
Yeah, I mean, right now, just this morning, you can go look at, Bank of England, Bank of Japan, and it's basically, you could almost swap in the headlines. It's, raise the growth forecast, hold rates, and that seems to be the story in the developed world, right? And the U.S. is no different. Raise the growth forecast, hold rates, see what happens. There's a little bit of a let's hold our breath and just wait for what we don't know is going to happen with the new administration.
And going abroad to other central banks that you just mentioned, is there anything that jumps out to you at the Bank of England, Bank of Japan, anything that jumps out to you that maybe bucks that trend you just said, or is that what you see going forward?
Yeah, we've seen a little bit of a deceleration in trend. So actually, although it had been rising at year end, it's actually dropped off quite a bit from both the Fed and the Bank of England. This is a little bit different than where we thought we would be heading coming into the new year. Growth has been fairly strong in both environments. Obviously, different cases, but similar types of risk. There's not a whole lot of knowledge about what's going to happen with Brexit in Britain, and there's still not a whole lot of knowledge about how the new presidential administration is going to affect the economy here in the U.S. And so there's a lot of people who are saying, came in thinking, hey, this is going to be great at year end, and then coming into 2017 said, maybe this isn't perfect. This might be a good opportunity to step back and say and see what's going to happen in the real economy.
I was actually going to ask you about Trump. You guys have your own algorithm, and you analyze what the Fed is saying. Any chance you can do a public service and do that for Trump too, so we can try to understand what he's saying?
Yeah, actually, so I guess there are two different answers to that question. The first is to say we actually already have done some work analyzing Trump's tweets. This is part of a broader move for us to expand out our coverage. So we have a proprietary methodology to analyze comprehensive, unbiased, quantitatively analyze the communications of central bankers, but we're also now doing that for corporations. Of course, I was listening to the show just now, and you guys were digging into earnings calls. We're actually releasing an earnings call product in just a couple of months. And so leading up to that, one of the things we've done is analyze every time Donald Trump tweets about individual corporations or individual corporate officers. And so one of the things we found is that despite a lot of the media coverage saying, he tweeted about this company and their stock price tanked, the statistical relevance to that is actually a lot less than one might think when he's mentioning companies. However, when he mentions individual personnel, so when Trump tweets about Rex Tillerson, Exxon stock price goes up. And so the tie between his mention and individual company pricing might be a little bit looser than we all thought, but the tie between his mentions of individual personnel and stock pricing seems to be quite tight.
That's really interesting. So you're saying that when he tweets about a company that we can more or less everyone not freak out, but when he tweets about individual, that is interesting. I never would have thought that. Okay. When can we get a timetable on that coming out, that product?
Yeah, so we put out a short paper about the Trump tweets on Inauguration Day. I would gladly share that with you, and you can share that with the Benzinga audience. As for the earnings call product, we'll be launching that in early Q2. The idea here is that we're going to be tracking every publicly traded company in the United States. We build a unique lexicon for each and every company, and it's purely based off of how the market previously reacted to prior earnings calls. So instead of us imposing our will and thinking we're experts in every individual stock, we look at how the market responded. If the market thought the sentiment of the prior quarter was quite good, similarities between that earnings call statement and the next one will allow us to say, oh, this next one's pretty good too, and so on and so forth. And so obviously there's a whole lot of complexity in the natural language processing here, but the end result is that we actually are able to have a unique custom lexicon for every stock.
Well, I will look forward to seeing that, because that's something that intrigues me very much. I think I'll see you in May, right, at the Benzinga FinTech Awards?
Absolutely.
All right, looking forward to seeing you, Evan. That'll be in New York this May. Evan was there last year. Prattle was there. Look forward to having you back again. Evan Schnidman, thank you so much for joining us this morning. I always love having you on the show because you're one of the more unique angles that people take on looking at central banks. So love your analysis as always, and I'll see you in a little bit.
Great. Thank you so much.
All right. All right, Joel. How are we doing now?
Right back here. S&P 68.75, down nearly 6 points here. Now it's down 6 points at 68.50. Dennis, how you doing there? I see that.
I should have hit the mark. When we were talking about it, I said 63 is the brick wall. I was throwing out some offers up there, 98, and trying to think it was going up. Okay, well, maybe it'll get up there, start printing the 63s in the pre-market. I'm have a nice short. I was looking at the 62.75 bid. I was like, I could just hit that bid. A 62.75, it's bid there. I'm like, I'm only really risking 25 cents because I already said, 63. In my mind, I'm risking 25 cents because I did not think there's no way it's open up over 63. And here we are 10, 15 minutes later, and it's down at 62. I'm kicking myself for not hitting the 62.75 bid.
Who in the chat hit it? Was it Angelo Raz? Was it Bob Wire?
One of you guys in the chat hit it on me.
Franken.
Yeah. It was you guys in the chat taking my trade.
Yeah, they were leading on your offer, Dennis.
Yeah, they hit my bid. I was gonna hit that bid.
Michelle K.
Talk work on the show.
Lucy, come on, you guys, fess up.
One of you guys hit that bid on me, didn't you? Knocked it down to 62. Anyways, congrats whoever sold up there at 62.75. I should have sold it.
All right. Well, we'll see what happens. Maybe you get a...
Talking about Merck. Ace, I don't know which stock they're talking about.
Okay.
Merck.
All right. Maybe you get another shot at it here. Did we finish up with the earnings parade?
No. The earnings parade could continue for a long time here because there's just a ton of stocks that reported. Let's jump over to Philip Morris. It's getting a good lift here this morning. PM trading up substantially in the pre-market. Should I give you my level here? You guys going to hit it on me again if it gets up there.
Hey, Fuzzy, it was Fuzzy that did it.
Fuzzy, you hit it. He says he hit it too. Multiple people hit it.
Fuzzy Zoller listening to the show.
Fuzzy, send me a Christmas card for that one. Anyways, okay, going back to Philip Morris here. PM Spencer, give us the numbers.
It's funny. Q4 adjusted EPS $1.10 versus $1.12.
Woo!
They missed by 2 cents there. And then sales, aside from taxes, $7 billion versus $6.67 billion. And then also
should I give you the number?
Also,
it's not going to get
guidance.
there.
We have some guidance too. Fiscal year 17 EPS 470 to 485. That's in line.
All right, I got a couple numbers for you. First, 98. That's the number, that had the high back then, and you can see there's a little bit of size. There are only 7,700 shares, but the book is like empty. So you're trying to see, it's funny. I see 7,700 shares offered at 97. I see 7,700 shares offered at 98. I can't see up to 99, but I'm assuming there's probably another 7,700 offered at 99. So some institution, I don't know if they, liked Ray Bork or Paul Coffey or something from hockey because that was their numbers, but they're trading in 77. So we'll see what happens there. But, here's Philip Morris, a big lift for Philip Morris. This is a stock that doesn't usually move like this. I think it probably struggles here, around 98. I think, if it ever got near $100, I'm selling with two hands up there. I don't think it's got the gas to get there, though.
It's up on very, very light volume here. A couple of monthly highs, 98.01 to 98.21. So opening into resistance, big run up since the $90 level, too, here. So I'd be more of a natural seller than a buyer at these levels. All-time high in the issue is quite a bit above this here, 104.20, but see the action at 98 first, see what happens. And did you see Altria yesterday? That thing had a wild session, and
yes, it did.
It opened lower, and you bought that open, and you were like, you got smoked. But once it came back through, it had a quick drop. But once it came back through that opening price, if you were so inclined, made a nice run. So wild session there. Philip Morris, though, starting out the opposite way.
Yeah, the MO was a wild session. I think Philip Morris could have a wild session here, too. And I'm not chasing it up $2.50 because these things can go all... up 3% defensive stock. Nah, not for me. I'm more inclined to short up there than buy it. Jumping over here, a lot of earnings here today, like we were talking already. Where do you want to go? Shutterfly? SFLY from last night? It's down 18%. Sounds pretty good.
Q4 EPS $2.63 versus $2.84. So big miss. Revenue 561.2 versus 583.8. Another big miss. They see Q1 EPS at a 95 to a $1 loss. That was estimate was an 84-cent loss. So they missed that. If that was possible, and the revenue $185 to $190 million. Estimate was at $199. So they basically missed across the board.
Missing across the board. I don't understand how, because I tell you, my wife spends a lot of money on this Shutterfly. She makes those picture books, and does them, and they send it. There's always a Shutterfly package coming to our house here. So I was like even saying to her, maybe we should buy that stock because of all this Shutterfly money is spent. They must be, but I guess she was the only one. I guess she was the only one.
No, she's not the only one. We got a stack of books on our coffee table.
You got the Shutterfly stack of books too?
That's what Lisa, when we take a trip or something.
Well, how's this company missing?
I don't know. I guess
me and Joel are feeding them money.
I don't know. Back at levels you saw in October of 2016, you have a pre-market low of 41.35. The low I'm referring to was 41.91. So to me, you're short. You're getting a huge windfall here. I don't know if I could hold out, not buying this in the 41 handle. Coming back on the upside after the big drop, you found some good sellers at 44.25. So 42, 44.25, some early levels here in Shutterfly. I mean, I guess other people are doing this as well, right? I mean, does Amazon have a picture book division or something of that nature?
I think there's a lot of competition in that industry, but Shutterfly I always thought was the best deals. The books are cool though when they come and they look really nice. They're fairly cheap to do. You upload your pictures down. Just be careful though, because I'm not on unlimited internet at home, and I looked at my bill and it was like I had an overage charge. I was like, what? And then I was like, trying to discuss, what it is, but uploading and downloading all those photos, that can get you on your internet bill. So you got to be careful with that one.
Why don't you have unlimited internet?
Cheap. I don't need unlimited internet. All I do is trade stocks.
Really?
I don't watch a lot of Netflix or anything like that. But those photo books will get you. That's the first time ever in 5 years that I've been over, and I was like, what is different? I'm trying to figure it out. It's the photo books, guys. A lot of pictures going up, a lot of pictures going down.
Wait till Spencer starts gaming on that the computer. You're gonna need a lot more internet then.
Yeah, that's what happens. Okay, jumping over. They're talking gold in the chat. Ecograph's talking gold. Gold is getting a big lift, so we should talk it. Gold's up, if you look at the GLD, up over 1% here this morning. I had some Agnico Eagle mines overnight. Nice little overnight trade for me there. Actually, this is, showing you just throw out the order. Sometimes good things happen, but I had just a couple hundred shares overnight that I bought, and it was a small position. It was just a little overnight trade. And anyways, I just threw it out there, 49.77 for the hell of it. I got done. I had done $2.50 higher, $2.37 on AEM for 200 shares. So now it's already offered for $8.94, but that seems like a way overshoot on Agnico Eagle mines. Usually, when gold goes up 1%, the miners go up about 3. Up 5, I'd sell out all day long.
Dennis, where did you buy this thing? This is
close.
Oh, you bought it on the close?
Yeah, this was one. It was a hedge. I needed some gold to hedge, like on my overnight portfolio. Sometimes I hedge all the time. And anyways, I was hedging a little bit. I needed some gold in my overnight portfolio. I got so many stocks all the time. I was like, you know what? Gold was showing a little bit of life there. I was like, I'm going to just buy a little bit of gold and Agnico Eagle mines. So I bought a little bit of that. Just 200 shares, small on the close. But anyways, 200 shares, $2.30, almost $500.
I mean, you're like the only trade in this thing here. I mean, not
a lot of trade. I just threw it out there because somebody else was at 49.77. I was like, hell, I'll join that guy. Boom, I got done.
Yeah, I can see the print where you bought the 200. But no, that was it.
You can see where I sold it. You can't see where I bought it.
No, you can't. No, I'm looking at it.
I bought it yesterday.
You bought it on the close, and then, wow. Not much volume there. Good call. 1220 area. I'm not going to go into all the individual stocks here in gold. I'll just go to the gold futures contract, which has rolled over, is now the front month, I believe, is, I'm seeing different things here. I think the front month is April now. Let's go to a daily chart here. You can see 1220. That's been the big resistance. You broke above there. Kind of open. I see a couple highs at 1230 area, but when you see these kind of open areas in gold, I mean, if it can hold 220, I could see 1240, 1260 pretty quickly.
Again, that's my rule of thumb, though. When you see usually about 2 to 1 or 3 to 1. So if gold goes up 1%, the miners will usually go up at least 2, sometimes 3. So that's kind of my rule of thumb when I'm trading the miners and I'm looking at gold. A lot of people just trade it like 1 to 1, and that's a mistake because gold beta is a lot lower than the gold miners. So I always trade a minimum of 2 to 1. So if I was doing a hedge, and let's say I was long 100 grand worth of gold, then I would, hedge it with, being short $50,000 or $40,000 worth of the miners. And that's a more natural hedge for you pair traders out there. But going 1-to-1, if you're buying 100,000 worth of gold, so I'm going to short 100,000 worth of miners, well, you're basically just long some miners, or just short miners then, because it's not going to, the miners are always going to move more than the gold itself.
All right, 8:35. We got a new guest coming on, and that's Craig Johnson. He's the managing director and senior technical analyst at Piper Jaffray. Looking forward to speaking with Craig. We'll be right back.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Chaikin Analytics. I'm your co-host, Joel Elconin, along with Dennis Dick and Spencer Israel, and we are joined by Craig Johnson. He's the managing director and senior technical analyst at Piper Jaffray. Mr. Johnson, how you doing on this Thursday morning?
I'm doing wonderful. You guys?
We're doing good here. Big earnings seasons here, but we're going to talk to you about technicals, and so goes January, so goes the market, and not a bad January at all. What do you think are the implications for the remainder of the year?
Well, I think right now it's an interesting time for the markets. There's a lot of questions about the new administration coming in, and there is kind of a, historically a honeymoon period that takes place when there is a new administration that comes in. But when I have a lot of conversations with investors, they're kind of torn between, is this the honeymoon period, or is there a swoon that is going to soon start to unfold? And right now, I would still say the pain trade is up. A lot of managers have been caught off guard with the election, and they seem to be needing to continue to add exposure. I think this market is going to get bought on any sort of little pullbacks and dips. That's kind of the price action I've been seeing over the last several months, or actually several weeks in here. And we continue to remain optimistic, and we're looking for 24 on the S&P. We do think there will be some volatility, but I think this year the sell in May could actually play out as true, which hasn't happened over the last couple of years.
What about on oil and gold? What are your targets there, and what do you see for 2017? Start with oil.
So in terms of crude oil, we do like crude oil. The chart pattern and setup suggests that we are putting in a pretty meaningful bottom. We're looking for $70, $75 over the next 12 to 18 months. And we are officially overweight crude oil. We're officially overweight the energy sector at Piper Jaffray. And again, we like what we see. And inside of energy specifically, we're making calls on refiners. We're also making positive recalls on the offshore drillers, as we think there's a lot of opportunity for those names. And we're starting to see in our proprietary relative strength work an improvement in definitely the E&P guys, and also starting to see, again, improvement in the refiners too. Now, in terms of gold, we are not a fan of gold at this point in time. We think the peak has already been set. And we continue to think any sort of relief rallies that do occur, those should be selling the yellow metal, in our opinion. When we come back and look at our group work, we continue to see There had been a really nice relief rally in the gold miners last year. That looks like it started to fail, and we would be reducing positions on that. As again, we think 1050 is a better and more likely number over the coming 6 to 9 months than some sort of trend reversal here. Again, I've said it before, and I've said it many times, that I still believe that we're entering a period of time for this market that is very similar to what you'd seen in the early 1950s or in the early 1980s, and that was not a period particularly favorable for the yellow metal.
All right, and you mentioned the energy sector. Any other, favorite sectors that, maybe are not so loved here? I mean, you look at, some of the biotechs are still, trading near, yearly or multi-year lows. Any other sectors here that, maybe haven't caught a bid yet?
Yeah, so in terms of sectors and industry groups, we're officially overweight energy, the basic materials sector, and also technology. We're also underweight consumer staples, utilities, and also our communication media space. If you drill down a little bit deeper inside of that, I'd say in the basic materials space, we're definitely buyers of steel. We're definitely buyers of the specialty chemicals, and also buyers of the ag fertilizer names. We think there's a lot of attractive looking opportunities in those particular names. In terms of things like biotech, we're officially neutral healthcare overall. I am starting to notice that the names in biotech appear to be starting to make kind of rounding bottoms in a lot of these names, and definitely is our attention. We are overweight that aspect of healthcare, but still neutral the sector overall. But those are a couple areas from my perspective that are starting to show nice improvement and improving relative strength trends.
What about just the valuations in some of the biotech stocks? Because, you compare it to the overall market, you got a stock like, even Gilead, not to go into individual stocks or anything, but just as an example overall, some of these valuations, on a multiple perspective are well under what the market is. Do you think there's room there for the value investor to eventually come in here? Or are these stocks just so, out of favor here that, this is just something that's going to have a difficult time turning around?
Well, it's hard to really evaluate any of these biotech companies on earnings because a lot of them don't have earnings. So the way that we have looked at the biotech names is, and we got a great set of fundamental analysts to do that at Piper Jaffray, but as we think about the space itself, and you think about the opportunities and the drugs and the delivery that they're working on, again, I think people are focused less on what the earnings are in the short to intermediate term and more focused on the end game of what those drugs could finally deliver. I'm seeing improvement in the charts. That's kind of where I spend the bulk of my time thinking about charts and relative strength. And I'm seeing a fair number of those names looking like they put in perhaps some sort of intermediate term low. And we would be buying some of these names out there. Celgene looks particularly interesting. Bluebird on more the small mid-cap side from our perspective.
So when you're making moves on things, do you take the technical or the fundamentals first and then try and find a technical formation, or are you more emphasis on the technicals? You're like, hey, the chart in this is indicating you may want to move, and then you pound on the table with your fundamental guys. How does it work for you?
So the way it works for us is first and foremost, we look at the technicals. We spend about 85-90% of our time thinking about trend and total return relative strength. From there, we will then back into the fundamentals. I'm free to agree or disagree with the fundamental opinions. I kind of view myself as kind of the Moneyball guy when it comes to thinking about stocks and equities because I look at the relative strength, I look at the trends, I look at ways that I can kind of increase our odds and probabilities of picking the right industry groups and also sectors, and then lastly, we'll think about the stocks.
Moving on to the Fed here, I mean, some impact on the market in 2017. Now it looks like they might be wavering on the next hike. What do you think the impact of the Federal Reserve will be in the overall markets in 2017?
Yeah, I mean, we put together a piece, we titled it, What Will Janet Do, right? And I think as you look forward into 2017, you probably are going to see, we think, at least 2 rate increases, possibly a third. But, I think having a non-event yesterday, like we did with the Fed announcement, is actually a good thing. there's been so much emphasis on the Fed and monetary policy over the years that I think it's nice to see us kind of take some of the emphasis away from, too much attention on what the Fed is doing. But overall, I think you're going to see rates go up. I think you're going to see Fed continue to nudge up rates, but they're going to do it, and they're going to do it on a very gradual basis. They know from having studied the Depression era that raising rates too quickly and basically extinguishing what is kind of a slow growing economy would be a very bad thing to recover from. So slow and steady from the Fed's perspective is what we expect.
Before we let you go, the Trump stocks or sectors, you did mention that briefly before. U.S. Steel kind of got hit after its earnings report, so steel's a little bit weak after the big rally. Financials, I mean, they've had a rally, the XLF, and just not really giving it back. Just a couple comments on the Trump sectors that have benefited so far.
So we are entering a new era, cyclical growth. I don't get a sense that there's a lot of investors out there that have really fully positioned into a cyclical growth type scenario. In fact, I had one investor point out to me that as a mid-cap investor, they can actually buy U.S. Steel. It's a mid-cap company at around a 4 or 5 billion market cap. What I think you ultimately see happen with some of these cyclical growth names, they've got maybe a little bit ahead of themselves. They might back up, but I think they're going to be quickly bought, from my opinion. It's an area in the market that has not garnered a lot of attention from investors over the last handful of years, and I still think that there's good upside. There's a really good risk reward when you look at the fertilizer names or the chemical names or the steel names specifically. Really nice risk rewards in there, and I think the market is looking to find some of those pro-growth names to really get invested in. So I still like these names. I'm a buyer of these on pullback. I'd also just mention, you mentioned the financial sector, but if you think back in history, have we ever had a really big pullback or correction in the market when the financial sector has been leading the way? History suggests no, that typically is not the case. And right now, I'm excited that the financial sector has run. It's not really giving up much ground. That's the exact opposite of what happened in 2007. And it's interesting, psychology among investors is 100-degree opposite right now, too. Everybody wanted to buy stocks in mid-2007. Everybody thought that any sort of pullback would be short and quick, and, well, that wasn't the case. And now they're very fearful of this market. So I think you're going to see this pain trade continue to move higher. The advanced decline line in the New York is up, and you're seeing the financial sector also going with it. To me, those are good signs for this market that will continue to work our way higher, at least a high single-digit type return for this year. All right, 24 on the S&P.
I got to sneak one more in here on you. We are in we're in the Motor City here, and GM and Ford, decent stocks, decent dividends. Give us your outlook for the big two here in the Motor City or the auto sector in general.
Well, there's we got a really good analyst, Alex Potter, that follows these names fundamentally. Set the fundamentals aside, and let's talk about the technicals first. But technically, a lot of these auto names are looking pretty interesting, starting to change trend. Fundamentally, there's some concerns over there with some of the trade policies that have been pointed out on the fundamental side. From my perspective, I think the autos are going to do well. Some of the auto parts suppliers look pretty interesting too, and there's certainly a pretty aged auto fleet out there in the United States. So I'm a fan of Ford. I'm a fan of also GM too.
We've been on the line with Craig Johnson. He's the managing director and senior technical analyst at Piper Jaffray. Craig, great information. We hope to get you on again soon.
Happy to do it anytime. Thanks, guys.
All right, 848 S&Ps near the lows of the session, down 6 1/4. Dennis, it's always good to get a technical analyst on, but boy, he sure pays attention to the fundamentals as well.
I mean, that's the one thing, and it's hard, in this market, and I try not to be a one-trick pony, too. I love my charts as well, but, even from listening to me, if you've been listening to the show for a while, I do a lot of other analysis as well. I still call myself an order flow trader. Like, I like to watch order flow, but, from a longer-term perspective there, I am analyzing the fundamentals of the company. I do look at, stuff like Gilead and say, hey, the valuation's just cheap on this thing now, and I think everybody's now overshot to the downside. Sometimes it takes a long time for those trends to reverse, and sometimes I'm very very early. Like I said, with the Gilead purchase, I bought it up at 80. I was very early with this, and I'm down 10% on that position. But, other times, you get them right. Like with my Procter & Gamble value purchase back in the day, I almost got the exact bottom when I bought it down at $68. And everybody starts to get bullish, and they like the trend. The momentum traders come in, and now it's a little bit more bullish up here at 87.40. But, I've sold it now because, from a valuation perspective, it's, not as attractive as it was. So my own personal take is, when I'm looking at, if I'm looking at it from an investment standpoint, I'm always analyzing the fundamentals first. What do I think about this company? And then, I look for the setup in the chart. So similar to what Craig was just talking about. From a day trading perspective, I don't really care so much about the fundamentals. I care more about, is the sector in favor or not in favor right now? And today, is the sector in favor or not in favor? Like I said, always with my day trading, the first thing I take is a top-down approach. Which are the strong sectors? Which are the weak sectors? Okay, now which stocks do I want to focus on that I think might open too high or too low? I'm going to short the ones I think that are opening too high and buy the ones I think are opening too low.
Just a quick note. I mean, just going to the Gilead here. I've been discussing this one with with Nick Shaheen, and it's just hard. I mean, like here I'm a natural just a call buyer here, right? And I'm thinking, man, if this thing can finally clear 73, it's in great shape. But when I talked to Nick about this stock a couple of weeks ago, he sold a put spread, and it's just this thing's gone nowhere in a week, right? But he's up on that position.
Getting paid.
He's getting paid. He's getting paid to wait. And then, he's probably, the spread he was talking about is far enough out, where, if it has a big drop, he's, he can lose some money. But the only problem I have with some of those positions is, the true risk-reward ratio. You sell some of these spreads, for, you do a $2 spread, and let's say you sell it for 60 cents, you're always thinking about the risk reward. Yeah, I can lose $1.40, but my upside's only 60 cents. But it sure takes advantage, especially in stocks that you want to own. Selling the puts or put spreads is a little bit of a
There's a strategy in there, for sure. Nick, has made a lot of money over the years playing those strategies. So, it's proven, that it works for him and it works for a lot of people. I'm a firm believer that the option writers make a lot more money than the option buyers. So, I've always been a fan. I used to always do it in my own investment portfolio as well. I used to write a lot of covered calls against my investment holdings. The one thing, that I've, hesitant because in a really raging bull market, you get called away and you lose all your stocks. So that's one thing, if you're just writing cover upside calls against all your stock positions there. When you really get into a bull market, you lose your stocks. You don't get to participate in the upside, yet you still have to participate in the downside. So, it's one thing with the covered call writing. There's more risk. I think there's a time and place to write covered calls. I think there's also a time and place, to write, in doing the put spreads that you were just talking about with Nick. But, that's a little bit of timing. But again, if you like the company, you don't like it at this price, but you would buy it if it went down below. Nick says, why not write, a put down below, 10% or 15% below the price if you're willing to buy the stock down there. If it goes down there, great, you get your stock. If it doesn't go down there, great, you get paid for the put. So, you can look at it from a win-win, but you got to want to own the stock, and you got to have the capital to own the stock. That's what I would say if you're writing the puts naked.
All right, I was looking at the ratings here, and I guess the most significant will be over at
There's
Bank.
actually quite a few.
Yeah, to me, Bank America here making a call here on U.S. Steel. A topsy-turvy day yesterday. Boy, that thing opened up right near the high and came down in the lower 31 handle. I was keeping an eye on this thing. Now you got to bounce right back up at 32 here. So what do you think about the Bank of America upgrade from neutral to buy in U.S. Steel?
Well, first of all, some props to Benzinga Pro last night because I believe they were the first ones to break this one last night. I was actually messaging with Brent, and I could see U.S. Steel just started taking off. I was like, is this upgraded? Because it was trading like it was upgraded. You can tell in the after hours sometimes, and Brent hunts it down. Sure enough, Bank of America was the one to upgrade the stock to a buy, and that was trading around $31.70 last night, and obviously now it's well over $32, $32.05. I mean, they're making a call here. They're, saying they like steel, or they're saying at least they like U.S. Steel here. The stock's pulled back significantly from its highs. We had the big move from 16 up to $38, so $39 actually. Closed at 31.33 last night. So I think it's more a valuation call here from Bank of America. It's pulled back. They maybe like it going forward, especially under a Trump, a Trump under Trump. So here we're looking, stocks trading up here. But am I chasing it up here this morning? I see a lot of overhead supply. I see a lot. Can it get up to 33, 34 bucks? Sure it can. But when you get that 34, 35 here, it just looks like there's going to be sellers all over the place because this thing has traded up there for so long. We always say price is memory. So if I'm buying it here at 32 today, I'm seeing maybe 2 to 3 points upside. But, the downside, there's a lot more risk there, especially if it was to take out yesterday's low, because it's really had that huge move from November and December. And I don't think it's going to go back down there immediately, but, it starts to get scary. So if I'm buying it here today, I wouldn't want to own it below yesterday's low.
I have a stock I want to bring up. New York Times. They reported earnings this morning, and they were coming off what appears to be their best quarter in years. So they passed the 3 million subscriber mark. It's their best quarter for digital news subscriptions since 2011. Total circulation revenue is up 5%. They reported Q4 EPS 24 cents. That's in line revenue of 439.7 versus $437 million. So I want to ask you about this and how it's trading, because this is without a doubt their best quarter in years. They got the Trump bump, and how are they doing?
You know what? It's not lifting much here in the pre-market, but I don't mind this setup on the dailies. I don't know. I'm curious what Joel thinks as well. I think if you could get above 14, I do see some size. Like I said, I'm always an order flow guy. I do see about 15,000 shares up there on New York Times at 14. That's not huge, but it's enough that it could, maybe stall the stock, stall the rally here. And is this one, I'm just looking at the way it's trading here. Is this in the tick size pilot? Yeah, it is. This is in the tick size pilot, so this thing trades in nickels. One thing, we never mentioned about the tick size pilot stocks is I've been trading them a bit. I find them more volatile. So I know they were saying, if you come in here with this tick size, on some of these smaller caps or mid cap stocks, small caps, that maybe there's going to be institutions that are willing, because I have 20 pricing increments, so liquidity will, form more at these 20 levels as opposed to being dispersed amongst 100 different levels. But I don't think it's been the case. I think the tick size pilot has been an epic fail so far, and I actually think it's increased the volatility on a lot of these individual stocks. So New York Times here, remember, it's tick size pilot stock trading in nickels. Really only has, it's 1380 was the last trade here, so it's got 4 pricing increments to go up to 14. So when they trade nickels, it's just different.
What kind of size do you see it?
You don't see the size either. I don't see more size, and it's less levels. And I've seen some stocks like just boom, 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 boom. They just start blowing through levels so quickly because it used to be, there'd be something the next penny, or there'd be 2 cents up. And it doesn't seem to be the case now. It seems like on a lot of these stocks, with only the 20 increments per handle, is that they blow through levels very, very quickly, and they blow through, a lot of these, it can, from my experience, and, I don't have any stats. I'm not sitting down here writing down and crunching numbers there. But, I trade, fairly, regularly a lot of these stocks, and from my experience, they feel more volatile. I don't know if anybody else has the same opinion there in the chat, but to trade in the tick size pilots, I think they're more volatile than they were before.
All right, Terry Curran mentioning New York Times. I mean, big coverage of the election. So, that was a driver for this quarter. What will be a driver moving forward? Also, is it Carlos Slim? He's been selling a ton here. He's probably been that seller at the 1380 level. So you hold 1380, clear through a little bit of size at 1420.
14's the bogey for me.
Yeah, 14's the bogey. I see a high at 1420. Conate 1314. Any thoughts on PULM? And I've seen this stock. It's been flying around lately, hasn't it? Oh, up 440. Big move yesterday.
Crazy mover.
Plum Matrix. I mean, once these stocks get in motion, you'd like to see them just take out the previous day's high. But on the decline here, trading down a little bit in the pre-market. I'll keep an eye. Went off at 373, so see if it can hold the close and stay green up above 440. You just may find some more buyers. All right.
Yeah, this is a stock that I don't follow. I want to get to Costco. We didn't mention Costco yet.
Yep.
And Spinner here wanted to know about it. And yeah, COST came out with some huge same-store sales here overnight. Costco actually traded 5 points here in the pre-market.
5?
Well, it's trading up 4 now. It was up 5. It was up more than that before. But that 165 level is enormous in Costco. Can it open over that? That would be a breakout for Costco. Let's see if it can. It's traded already 60,000 shares. Most of those above. How high did we get on Costco?
168.06.
170. I'd be selling 2 hands up there, but I don't think it's getting there. What were the numbers, Spencer?
Net
Or Costco?
sales for the first 4 weeks of the year was a little over $9 billion. It's about a 9% increase year over year, and then same store sales for January up 7% year over year.
Watch Walmart, Target on this too. They're both trading down here in the pre-market because the market's weak, but I would not be surprised if Walmart catches a bit off Costco. I've seen that happen before. If Costco can stay strong and it's starting to come in a little bit here, wouldn't be surprised if Walmart catches a bit.
All right, high of the day may be in there, 168.06. All-time high, 169.59. All right, 859. Spencer, you want to wrap
We're
up
gonna
the show?
take our final break of the day. We're gonna grab our last guest, Sandy Chaikin. She's got a very interesting story. I know most of you listeners are traders yourselves, and I think you're gonna be like what she has to say. She's someone who she had a separate career as a marketing executive. She knew nothing about the markets, nothing about trading or investing, and got hit really hard in the financial crisis. And so she kind of took matters into her own hands and built her own portfolio basically from scratch. And that was about 5 or 6 years ago. And so she's going to tell us about how she went from literally knowing nothing to feeling confident enough to trade, to buy and sell individual stocks, and what stocks she's bought since then. So we'll be right back with Sandy Chaikin.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick, and we're on the line now with Sandy Chaikin. And as I mentioned before the break, she is someone who does not have a career in finance, didn't really know anything about the markets or investing before the financial crisis, and she kind of used what happened there as the impetus to get started and building her own portfolio. So, Sandy, first off, thank you for joining us, and tell us about what happened.
Pleasure.
Tell us about what happened to you during the recession, and what prompted you to kind of decide to start looking at the stock market.
Sure, Spencer, happy to do that. Although I wasn't happy at the time, because in 2008-09, I saw my portfolio drop by 40%. And that, to me, was absolutely overwhelming, staggering, totally disappointing, because I thought I had done everything right by having it managed by a professional. But the learning was that I really had to take control of this myself. And I really had to understand how the markets work and how to invest in stocks myself. Because as I always say on my webinars and presentations, nobody cares more about your money than you. And that starts with me. So during that whole meltdown, I could see the value of my portfolio go down, and I would repeatedly call the wealth manager who had the account and say, hey, don't you think we should sell? Everything is clearly going down. And his advice was always, no, it'll all come back, just stay the course. And because I lacked the confidence to override his opinion and suggestion, after all, he is the professional, not me, I paid a huge price. I worked my whole career, 30-some years, to build that portfolio up. And to watch it disappear by 40% practically overnight was truly devastating. So that also was the catalyst, not only to get me off the bench and say to myself, Sandy, you got to learn how to do this. But it also was the catalyst for starting Chaikin Analytics, which my husband and I founded in 2009 after this whole meltdown. And we did so for the sole reason of helping individuals like me manage their own money. Because what was evident was that there was literally billions. I think it was 400 billion is the figure of money that came out of traditional brokerage accounts like I had, and went into self-funded accounts like I did, putting my money in, opening up a Vanguard account and putting it into an S&P 500 until I could figure out what to do. Well, I wasn't alone. I mean, literally, there were billions of dollars making that same route to self-managed accounts. But as Mark said, Sandy, you don't know what you're doing. You don't have the tools and you don't have the knowledge or the background to know how to manage your money.
So then tell us about then how do you find your ideas, because a lot of our listeners, the reason they listen to our show is because they like talking about setups and the market and pre-market action. So how do you find your ideas for what stocks you want to invest in?
Very simply, Spencer, I use the screener that we have on the Chaikin Analytics platform, and I can quickly explain what that is. But you can plug in a number of different variables like money flow, Chaikin money flow, relative strength, any of the 20 factors that make up our model. You can plug those in and identify stocks that meet that criteria. We also have a discovery engine. So if you like, say, Facebook, you could plug in Facebook to your discovery engine, and just like a Pandora for stocks, or a Spotify, is for music, it would find you in seconds other stocks that have the same criteria as Facebook, for instance. I typically use the screener, and I'm going to demonstrate how I do that on the presentation to your audience this afternoon. But I find that really saves me an enormous amount of time, because I can plug in what I feel are important, and they're basically 7 things. I plug them in: strong power gauge rating, strong industry group, strong price to sales, strong insider activity, meaning insiders are buying, a strong short interest, meaning the short sellers are not shorting, strong relative strength to the S&P, and strong Chaikin money flow. And for instance, I ran that yesterday, and I have 6 stocks that meet that criteria. So I've gone from an overwhelming universe of 5,000 stocks down to 6 in seconds. And I can give you 2 of those that I'm going to be talking about this afternoon.
Go for it.
On my presentation. But one is Progressive Insurance, PGR, and the other one is Radion. That also is an insurance group, RDN. And those 2 meet all of that criteria that I just went through, and are now on my watch list. So I'm just waiting for the right time to buy them.
Yeah.
And I do like to wait till they're oversold.
And we have PGR, we have PGR up on the platform right now on the Discovery Engine. It's up on the screen if you're watching at home. So that's what that looks like. You can see there's stocks like it, and then it also gives you short candidates, which I find interesting. And it's not just a traditional sympathy play that you might find, for maybe on Google Finance has a little bit more in depth than that. Okay, so you mentioned the webinar. You have a webinar today on your site. Can you give us some more information about that? What do you talk about, and who is it kind of geared for?
Well, it's geared to investors at all skill levels, anyone from a novice investor to a knowledgeable investor. And what I do is walk you through the 5-step process that I've endorsed to find winning stocks and avoid the losers. So I go through, how do you identify a strong stock, and get in on that stock before the price accelerates? And equally as important, how do you get out of a stock before it really breaks down? And I walk you through the signs, the signals on the platform, on the Chaikin Analytics platform, that help me and guide me on the time, not only what to buy, but when to buy. And we believe the when, is just as important as the what. So, and getting out, I think as I've gotten feedback from my listeners on my presentations, many people struggle with timing. How do I know when to get in and how do I know when to get out? So I cover that as well. So my goal is to help other investors avoid the trap that I did of not being knowledgeable about your own investments and not taking control. And my goal is to give you confidence, because if I can give you a set of tools and a methodology that's reliable and proven effective, that will in itself give you confidence to pull that trigger, on, say, a Progressive or a Radeon or a Facebook before they report earnings. You'll have the knowledge to know how to do that. And that's my goal, because I really don't want anyone to go through what I painfully went through in 2009. It was just a horrendous jolt to my confidence and my whole outlook on what to do, because I thought I was doing everything right. So my goal is to show you how to avoid those pitfalls, embrace a methodology that works,
and
build confidence.
You can find Sandy's webinar. The link is actually in the chat right now. It's chaikinanalytics.com/premarket. So CHAIKIN analytics.com /premarket. It's at 4:15 Eastern. Today, Sandy, thanks for joining us. I enjoyed the conversation just because we have a lot of professionals on our show, right? People who have spent their lives, like your husband, who spent their lives, in the markets and learning as part of their job. And that's not you at all. You're just a regular person who kind of took it upon yourself to take control of your portfolio, and I think that is incredibly admirable and a scary thing to do, right? So it's a new perspective. So thanks for coming on, and I hope anyone listening to the show, if you're interested in hearing more about this, you can go to the link that's chaikinanalytics.com/premarket, and you can check out Sandy's webinar. It's at 4:15 Eastern, like I said. So, Sandy, thank you so much for joining us today, and good luck, and we'll talk to you again soon.
Spencer, my pleasure. Thank you so much. Take care.
All right. That is it for us today. So that's it for the show. I hope you enjoyed our chats with Sandy, Evan, and Craig. I want to remind you that all of the information and material and content from our show is for informational purposes only and not meant to be investing advice. So have a good rest of your Thursday, everyone, and we'll be back with you folks tomorrow, final show of the week. We've got a great slate for you. Arthur Hill and Seth Merrin on the schedule. So have a good rest of your day. We'll be back with you on Friday.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.